Hello everyone. Today we are going to study the basic concepts of income tax law as an introductory part. The first concept is tax. We must know what is tax. So tax is the fee charged by the government. There are basically two types of taxes: direct tax and indirect tax. Direct tax is imposed on person's income directly, and indirect tax means the tax is levied on goods and services and prices of goods and services. Let's see. There are two types of taxes: direct and indirect. If the tax is levied directly on the income or wealth of particular person, then it is called as a direct tax. Mainly two taxes are under the head of direct tax. And indirect tax is levied on prices, price of goods and services. Now, why government collect this tax or levy this tax? In simple way, for the public expenditure or social expenditure, government collect this tax from the general public. General in the sense throughout direct and indirect taxes. The main reason is the tax is the main reason or main source of revenue, and this revenue is utilized for the expenses like defense, provision of expenses, healthcare, infrastructure facility, roads, dams, etc. etc. Now the overview of income tax law in India. In India, Income Tax Act 1961 is come into force with effect from 1st April 1961. There are various components of income tax law. We see one by one. The Income Tax Act. The whole act is applicable to the act is wholly applicable to the government. Annual Finance Act, Income Tax Rule 1962, circular and notification issued by Central Board of Direct Tax. CBDT is the higher authority, and legal decision given by the courts. Now the Income Tax Act, it is with the effect from 1st April 1961. The tax is levied. This act come into force on 1st April 1962. It contains 298 sections and 16 schedules. The sections and schedules may be changed or addition in the every year with the finance bill finance act filed by parliament. Next, income tax rule frame to facilitate proper administration to the Income Tax Act. Finance Act. We know government declare the budget every year. There are various decisions are taken into this budget. Every year, the Finance Minister of India present the budget to the Parliament. Basically, these budgets have two parts. Part 1, that is Part A, and Part B. Part A, the budget speech, and Part B for the tax purpose. That is, Part B is the budget speech contained to the detailed tax proposal which are applicable to the whole India. In order to implement it, the proposal bill is introduced in the Parliament. Once the bill is passed in the Parliament, it becomes the Act. Income Tax Rules 1962. This is the higher authority, CBDT, that is Central Board of Direct Tax, administrate the direct tax in India. CBDT makes the rule for the purpose or carrying out this act. Now the circular and notification issued by the Supreme Court and High Court is to be considered in the Income Tax Act. This circular issued for the guidance of the officers and for the assessing. Case laws, various case laws, also the part of the Income Tax Act. Supreme Court is the apex court of the country, and the law laid down by the Supreme Court, the law of the land. The decision given by the various high courts will apply in the respective state in which such high courts have jurisdiction. The next part is levy of income tax. The income tax is basically levied on the person's income. Now, what do you mean by person? So, person include an individual, Hindu undivided family, that is HUF, association of person, body of individual, a firm, a company, etc. Now, what is income? Income is basically amount earned by the person by the way of employer-employee relationship. The concept of income is very vast. The definition of income as per Income Tax Act being with the word income includes. Therefore, inclusive definition and not exclusive. Income generally means a periodic monetary return which occurs or is expected to occur regularly from definite source. Income also include the revenue received, capital receipts are generally not included within the scope of income. Income means net receipts or gross receipts. Income is taxable either on due or receipt basis, whichever is earlier. Income earned in the previous year is chargeable to tax in the assessment year, and the previous year is the financial year ending on 31st March, in which income is received or accrued. Basically, these two concepts is important: assessment year and previous year. Assessment year means the year in which year we calculate the tax on our income, and financial year means the year in which we earn the income from various sources. Now total income and tax payable. When we have to calculate the total income and tax payable to the government, there are various steps. Step number 1 is to determine the residential status. Residential status is vary from person to person. Tax payable to the government is depends on the residential status of the person or company. So we have to calculate or find out the residential status, whether it is residence, non-residence, or residence or but not ordinary residence. Then after we have to classify the income under the various heads, such as income from salary, income from property, income from business profession, capital gain, and income from other sources. Then step number 3, we have to find out the income which are not chargeable under the income tax. Step 4 is computation of income under each head, clubbing of income of spouse, minor, child, etc. Step 6, set up and carry forward and set up of losses. Step 7, computation of gross total income, deduction from gross total income, after that the total income, and step 10 is application of rates of taxes on total income. Thank you.